Hey guys, how's it going? Today we're going to be talking about how to get started in the stock market. All right, let's get started with step one. So, step one is to research and find 10 to 20 stocks that you want to invest in. So, for me personally, I like to find stocks that I think will outperform the market, like the S&P 500, which is usually represented by the spider. So, in my opinion, these are 10 stocks. I have several more, but this is just 10 that I thought would beat the market. So yeah, we have FRCOI, that's like Uniqlo, TTCF, Tattooed Chef, CRSR, Corsair Gaming, ZM, Zoom, AMT, American Tower, ETSY, Etsy, TDOC, Teladoc, MTCH, Match, Amazon, AMZN, and last, NVIDIA, NVDA. All right, so you should have your own list, or you can copy this list if you want, whichever you want. And then after that, we'll go on to step two. Step two is to find the date of the next 10Q or 10K for the company. So whenever they're going to release their 10K or their 10Q, that's like their earnings report. For me, I get this information through a Google Play app called Investing. You can find it on Google Play. Just yeah, this app here, investing.com, stock/finance/market news. What you do is you type in the ticker symbol and then you scroll down. After you scroll down, you'll see when their next earnings date is. And yeah, these are the dates for the 10 companies. So once you find the dates, next one, step three, is to find the current stock prices. These stock prices here are just rough prices, not exact to the penny, but as of June 20th, 2021. And then, yeah, after you find the prices, we go on to step four. So step four is to prioritize which stocks you want to buy first. This is assuming that you're going to dollar cost average your way in. If you don't know what dollar cost average is, it's like buy a little bit of each company in small chunks, and then after a certain period of time, you'll have all of the shares that you want in each company. It's not like buy all at once, just spread out your purchases over a period of time. That's what dollar cost averaging is. So if you do decide to dollar cost average, prioritize the stocks with the highest share price and or the closest 10K/10Q release date. So what we have here, FRCOY, that those guys, they have a 10Q or 10K coming out on July 15th, 2021. That's pretty soon. So we want to prioritize buying some of that first. Or also Amazon. Amazon has the highest share price out of all of these 10, $3,487 per share. So that's also going to be prioritized as a buy to get really early in the process. And then after that, we have Nvidia. Nvidia is quite high as well compared to the others, $745 per share. All right, so once you've prioritized which stocks you want to buy first, next, oh wait, hang on. Before we get to step five, I think we have some questions. Yeah, so before step five, really quick question: why buy the highest share price first? So let's just use this as an example. If I was going to get these 10 companies, you'd want to try to spread out your purchases as evenly as possible. So like invest an initial amount in each company, make that initial investment roughly equal for each company. So let's say we have 3,500 for the portfolio limit. So 3,500, not 3,500, 35,000 divided by 10. So whatever that is, put that amount in each stock. So 35,000 divided by 10, 1/10 of that would be roughly 3,500. That's why we have Amazon here. We want to get Amazon first. Why? Because let's say the market increases 10% over 1 month, and then you have two stocks, stock A, which is $100, stock B, which is $3,000. Assuming that these stocks follow the market increases roughly, I mean, they won't always follow it exactly, but just assume that they do. If stock B increases by 10%, it'll go up to 3,300, which is a $300 increase. Whereas stock B, if that were only to go up by 10%, that would only go up by $10 to $110. So if you wait 1 month to buy B, the extra amount of money, that's $300 extra you'll have to spend is more than A. So this 300 is more than the $10. So you'll have less to spend on other stocks and it will be more difficult to balance your stocks. When I say more difficult to balance your stocks, it'll be more difficult to make sure that you have a equal amount of money in each stock. Like maybe if you don't buy B first, that very expensive stock first, maybe you'll have to pay even more than $3,000. So maybe you'll have to pay 3,300, maybe 4,000, and then all that cash will be in B. So B is going to be like overweighted in your portfolio, and then you won't have enough to spend on the other stocks. So you'll be over invested in B. So that's what we're trying to prevent by buying the highest share price first, to prevent that share price from going, to prevent yourself from buying that share at a higher price. All right, next question is, why buy stocks with the closest 10Q or 10K first? So if a company's 10K or 10Q comes out soon, usually, not always, but usually that stock price will typically go up a lot or go down a lot after the report. It really depends on what the numbers are and how the market reports, how the market reacts to those numbers. And the thing is, we don't know how the stock price will react to the earnings report. So for me, I like to buy about half before the report and then the other half after the report. It helps me sleep at night. And if I only plan to buy one share and the earnings report is coming out soon, so something like Amazon, like for this portfolio, I only plan to buy one share of Amazon. But if the earnings report was coming out soon, I would rather buy before the report. So if the report is bad, let's say I buy the Amazon stock and then Amazon releases the report, it's really bad numbers, and then the stock goes down. No, there's no need to worry about it. I would just hold it. That's why we diversify. We don't put all our eggs in one basket. On the other hand, if the report is good, then it'll go up by a lot, and then we would have gotten it at a really good price. So yeah, that's what I like to do. Anyway, I think we're going on to step 5 next. Yeah, step 5, dollar cost average. As I said before, that's you spread out your purchases. There's many different methods that you can use to dollar cost average. This is how I like to dollar cost average, and that is buy once every 2 weeks and complete all purchases in about 1 to 3 months. So if you do that, you'll be doing 2 to 6 purchases. So for example, 1 month, if you buy once every 2 weeks, 4 months in not 4 months, 4 weeks in 1 month. So if you buy every 2 weeks, you'll buy 2 times. But if you spread it over 3 months, it'll be 6 times. So yeah. And spend however much you feel comfortable per week, but really important, do your best to buy roughly the same amount every week. So for example, if it's week 1, you're spending like, I don't know, $1,000 on stocks, and then week 2 you buy nothing. Week 3, make sure that you spend as close to $1,000 as possible. Don't make it like $100 or $3,000 or something like that. Just as close to $1,000 as possible. That way you're consistent. And yeah, so for example, week 1, there's 2 different options that you can do for dollar cost averaging. That is to have a set day and time to buy your stocks for the week, no matter what happens. So for example, let's say week 1, you're like, oh, no matter what happens in the market, I am going to buy at like 1 p.m. on Wednesday. No matter what, 1 p.m. Wednesday, that is when I'm gonna buy all the stocks for that week. Or option B, I personally like to do this just because I don't know, I like to try to time the market, even though I know I can't. I just give myself that 1 week times 1 week amount of time to do that. So for example, I would give myself 1 week, and I must buy everything for that week by the end of the week. So for example, maybe it's Monday, and I'm trying to look for a good price to buy something, and I don't see anything good. Maybe Tuesday, oh, I see one stock that I want to buy, so I get that one stock on Tuesday at a certain time, but then I still have 2 more stocks to buy. Maybe I wait all the way until Friday. Friday, I still don't see a good price, but I still have to get those 2 stocks. So Friday at the market close, I must buy those last two stocks no matter what, even if I do not like the price. I have to fill out everything by that end of the week. So that's going to be week one. And then after that, week two, do not buy anything no matter what, cannot buy anything. And then after that, just repeat until you fill out all of your positions in each company. So yeah, that's the step five dollar cost average. After that, why not just buy everything at once? You could do that. Some people do that. I mean, there's nothing wrong with that at all. Personally, for me, I just like to dollar cost average because it reduces my risk. So, for example, let's just pretend that you do buy everything all at once, and then after you buy everything all at once, let's see, there is a crash. Stock market crashes, prices go down like crazy. I mean, you could have bought at the high and then it just boom, just goes down like crazy. Or you have the opposite scenario where the market could skyrocket right after you buy. So like you buy at a certain level and then just boom, it just shoots up like crazy. But the thing is, it's really hard to tell what the market will do in the short term. So what should you do? Should you dollar cost average or should you buy all at once? Well, everyone is different. There is no one size fits all. This is how I like to decide what to do. You can do this too if you want. I like to imagine the two extremes of what could happen after you start investing. So, for example, let's say you start investing on January 1st. That's your first week to buy, and then you either dollar cost average or you buy all at once. And then after that, over the next 2 months, the market could go up a lot extremely fast, or it could go down a lot extremely fast. These are the two extremes. So let's imagine it's March 1st, and then you've dollar cost averaged over the past 2 months, or you've bought everything all at once on January 1st. On March 1st, you want to look back to January 1st and ask yourself, with the information that I had at that time on January 1st, do I regret what I did? And then choose based on the least regret for both situations combined. So, for example, if you dollar cost averaged over those past 2 months, and then the market increased like crazy, or maybe it decreased like crazy, take both of those feelings, just combine them and see how you would feel, and then compare that to going all in all at once. So if you bought everything all at once, and then the market went up like crazy, obviously you'd feel good. But then if you went in all at once and then the market went down like a lot, you'd feel pretty crappy, I guess. So you'd want to like take the average of those two and then just choose which one you would feel the least amount of regret in. So for me, I prefer to dollar cost average because it helps me sleep at night. I'll have less regret, you know? Yeah. Anyway, let's keep going. Next one. What to do next? So let's say you've purchased all of the shares you want. So let me go back really quick to the example. Like for this, you've already got all of the FRCOY you want, all the TTCF you want, all the match you want, like everything. You bought everything. You fully filled out your positions in all 10 companies or 10, 20 companies, whatever it is. After that, what do you do next? Increase the companies to around 20, keeping the initial investment for each new company roughly the same as your original company. So, for example, let's go back, like Amazon. Let's say you got Amazon at this price, roughly 3,500. You're trying to spend 3,500 in each of these 10 companies. For the new companies, let's go back here. For the new companies, you want to spend roughly the same as your original company. So you also want to spend roughly 3,500 for each new company that you add. And then once you hit around 20, slowly add more over time to companies that are outperforming the spider. That's what I like to do because the goal is to outperform the average. And then what do winners do? They keep on winning. So once you find a winner, keep on adding to it. Add to your winners. Do not add to your losers. Water your flowers. Do not water your weeds. You want to water your flowers, keep your winners, and trim the weeds, trim the losers. Do not double down in general. All right, so we did that. Next, keep investing regularly. So dollar cost average, buy once every 2 weeks. Just buy regularly. Don't try to time the market, you know. And let's see, if you do have 20 companies and then you find more companies that you want to buy, just add them to your portfolio. Again, same initial starting investment as your other companies. And then, really important, hold all of your positions for as long as possible. And holding is the hardest part. So, for example, let's say you have a winner in your portfolio and then it went up by maybe 100%, then you see it go up 200% and 300%. Like maybe you bought it for $100. Now it's at went up 300% to $400. You're like, oh my god, it went up so much, 300%. I'm gonna sell. It's so good. And then that's from that point, it just goes up even further, and then like you feel crappy after it went up. So the thing is, hold on to your winners for as long as you can, because you don't know how high it can go. It can go up infinitely high. So that's the hardest thing to do. Just hold on to your winners. And yeah, one winner can make up for all the losers combined. So, for example, if you have another stock, maybe it went down 80% or it went down the max 100%, that one winner, it can go up by more than 100%. So, that one winner has infinite potential for growth. So, because of that, that one winner can make up for all the losers combined. So, for example, hypothetically, let's go back really quick. Back to these 10 stocks. Let's say that I don't know, Nvidia, it just went up like crazy, and then all the other 9 stocks, they just performed horribly. They went. Let's give us the worst scenario. These guys all went to zero. These all went bankrupt, but we held on to everything, including Nvidia. But Nvidia, there was no limit to how far it could go up. So let's say we lost 100% in each of these 9 stocks. So if we had, let's keep it simple, $100 in each company, we would have $1,000 total, and then we lost $900. So this one company that we had $100 in, that could go up by what, 900%. It could, or more. So let's just say it just went up insane. This Nvidia could replace all of the losses from these companies and give us profits. So yeah. So hold on to everything as long as you can, even if it's going down, even if it's going up. Just hold on as long as you can, and that will give you some gains in the long run. At least that's what I think. So yeah, I think that was it. Let me go back here. Yeah, one winner make up all for all the losers combined. Yeah. So, final notes. If you don't know what my goal is to outperform the spider, which is something that tracks the S&P 500, which is the market averages. If you want to check out my Google Sheets in the description below, you can see my other stock picks and see how they're doing to the spider. And yeah, if you want to check out the discussion tab, you can check that out. I post comments in the discussion tab if I can't post a video for some reason. And yeah, also if you do go to the tab, just make sure you click newest first so you can see what my latest post is. Anyway, that's it for today's video. I hope you guys have a good one, and I'll see you guys in the next video. Bye.